Good morning and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us here at ausbiz. Let's check in what happened overnight. Fairly subdued session. That's because Wall Street was closed for Thanksgiving Day. US equity futures higher though. S&P 500 futures are up around 1/3%. Canada's main stock index touched a record high, supported by healthcare and energy shares, while investors considered US President-elect Donald Trump's threat to impose hefty tariffs on Canadian goods. European shares were higher across the board. The Stoxx 600 index rising 0.5%, recovering from some of its losses in the previous two sessions. And London's FTSE stock index nudged higher in light trading volumes, with insurance stocks registering their biggest one-day gain in 4 years. That's thanks to Direct Line Insurance, which surged after rejecting a takeover bid from Aviva. And the European markets were boosted by a rally in tech shares, led by gains for ASM International on reports that the Biden administration's curb on Chinese chips could be less severe than expected. And defence stocks led sectorial gains, boosted by rising Airbus shares. Well, at home, Treasurer Jim Chalmers last night struck a deal with the Greens in the Senate crossbench for the biggest overhaul of the Reserve Bank in decades, with it to be split into separate committees for interest rate setting and governance. Meanwhile, RBA Governor Michelle Bullock has said she expects inflation to return sustainably to the midpoint of the bank's 2 to 3% target range by late 2026, as its restrictive monetary policy gradually brought the economy and labour market into better balance, saying the goal underpinning the strategy has been to preserve as many of the jobs that have been created over recent years as we can. This is what we have previously referred to as the narrow path. We still think we are on the narrow path. Well, given the US Thanksgiving Day holiday, attention turned to French government bonds, which edged lower, with investors worried about France's finances and heavy debt burden, exacerbated by the latest round of political uncertainty that has left French bonds trading almost at parity with Greek 10-year debt. Well, the US Treasury physical market was closed, but futures remained open, implying 10-year yields falling from 4.26% to 4.24%. Markets pricing in a 60% chance the Fed funds rate will be cut by 25 basis points at the next meeting in December. And the US dollar index is up slightly on the day, while the euro dipped as traders reined in the bets for more interest rate cuts by the European Central Bank. And the Aussie trading at 65 US cents. Bitcoin is lower at 95,500 US dollars. In terms of commodities, oil prices slightly higher on signs that the ceasefire between Israel and Lebanese armed group Hezbollah has been violated. Brent crude futures up 0.5% to $73 a barrel. Copper slightly higher, as is iron ore, which is at $103 US a tonne. And gold is firm to $2,640 an ounce as geopolitical uncertainty and trade war concerns boost safe haven demand. Well, to get across what we're seeing in Europe and the UK at the moment, particularly given that political uncertainty, I caught up earlier with Fiona Cincotta from City Index.
Yes, you're right. So we've had, as you said, subdued notes in the US, but in Europe we've seen a little bit of modest trading. But I think broadly speaking, the picture in Europe is quite a lot weaker than what we're seeing in the US. I mean, we just think about sort of on political terms, obviously we've had the elections in the US, and that's resulted in the Trump trade, which actually has helped lift US equities to all-time highs. In the Europe region, that's been fairly different in the sense that we've had political uncertainties. We've got, for example, France at the forefront of our mind. And that's being sort of reflected in weakness in French assets, more broadly speaking. What's going on there is basically we have a coalition government that's really looking very unstable as they're trying to pass through a budget. Whilst on the one hand, you've got PM Michel Barnier, who is trying to cut spending to shore up public finances in France. But then you've got, on the other hand, a lot of problems as far as the left are concerned, and also on the right. So you've got both sides of the coalition causing problems. And basically, there is this concern that the budget won't get pushed through. And if it does get pushed through, it will be pushed through because Barnier's had to really come back and sort of rein in expectations and cost cutting. So that's basically opening France up to the possibility of political instability, but also financial instability. And as I said, as a result, that's being reflected in a sell-off of assets. We've got the financing costs for France have widened really quite significantly against those for Germany. They're at the widest level since the 2012 crisis. We've also seen a sell-off in the CAC. It's down 6% year to date, which is quite in contrast to the all-time highs that we've seen in the US. And then also, in addition to those concerns in France, we have that political instability in Germany as well. Then you've also got the concerns over trade tariffs potentially coming in from Trump when he comes into power in January. So all of this is making actually for a rather weak positioning for Germany as well. We've seen the DAX actually trading in more of a holding pattern recently. We're seeing it sort of being supported on the upside, limited on the upside by around the 19,500 level, and supported on the downside by around the 19,000 level. But actually, I think, given the threats that there are, or the outlook, which is deteriorating for the German economy, we've also had German consumer confidence come in weaker than expected. We've also had German business climate weakening as well. So I think given that outlook, potentially there is more risk to the downside. So we'll be looking for a break below that 19,000 level in the DAX. And then I think, add all this together, and actually that also adds for a weak picture for the euro as well. And, we've seen that playing out in the euro, which has, dropped to 2024 lows. It's really fallen quite considerably over the last 2 months, down to that low of 103.30. Now, we have seen it pick up a little bit from that low of 103.30, but actually, I think, again, the outlook here is weak. The chart pattern continues to be bearish. We really need to see a rise above the 106, 107 level in order to be able to feel a little bit more relaxed that the sell-off isn't going to be continuing. But yeah, so there's quite a lot going on in Europe at the moment, and I think broadly the outlook is to the downside.
Yeah, you certainly underlined that political uncertainty as well, both in France and Germany. Also, perhaps in the UK, of course, the Labor government there hasn't been in power for that very long, but is proving to be very unpopular. Why is that?
Yes, so I think a lot of this comes down to the budget that we had that was unveiled on the 30th of October. Now, what the Chancellor Rachel Reeves decided to do was hit businesses with the vast majority of the tax hikes of around 25 billion. And that basically caught a lot of businesses off guard. It's not gone down particularly well. In fact, we had data out today from the service sector here in the UK, which is the dominant sector. And it actually showed that sentiment in the service sector had dropped at the fastest pace in 2 years. And that was directly as a reflection and as a reaction to these increased taxes that we're seeing come as a result of the budget. Now, I think as far as the pound is concerned, the pound has weakened, obviously, against the stronger dollar, but we are finding that it's actually a little bit more supported just because the Bank of England doesn't think it's going to be able to cut interest rates as fast as it was hoping to, because this budget is actually expected to be quite inflationary as well. So with that in mind, we are seeing a little bit more support in the pound compared, for example, to the euro. But as you pointed out, it does mean that the Labour government isn't particularly popular, despite being in power just for a short amount of time.
And what have you seen as far as UK equities are concerned, Fiona? How are they performing?
I think UK equities are a bit of a mixed bag. I think obviously with the FTSE, it's very much related as well with resource stock to what's going on in China. Obviously, we have seen some weakness in China, and there are ongoing concerns regarding the outlook from China, despite the stimulus measures that we've seen. And that sort of really weighed on the miners, for example. Also, we've seen oil prices just fall for the past few days as well. But broadly speaking as well, if we're looking at sectors within the FTSE, For example, house builders, they're coming under a bit of pressure. We're seeing retailers down as well. So I think broadly speaking, the FTSE is definitely not having its finest moment. I think there are quite a few challenges ahead. But what we do find, though, is if there is weakness in the pound, that does offer a little bit of support to those multinationals on the FTSE, given the beneficial exchange rate. So that's sort of the only thing that's really offering some upside as far as the FTSE is concerned. But as I said, I think it's weakness that we're broadly seeing.
And Fiona, as we look towards 2025, how would you describe sentiment in both the UK and Europe, with the prospect, of course, of another Trump presidency? And we've already heard of his threats in terms of tariffs and how that's likely to affect global trade. What's the reaction been in both the UK and Europe?
Yeah, so I think there is definitely a feeling of caution about the year ahead with trade, with Trump having a second administration in the US, because of what that might mean for trade, particularly with Europe. Between Europe and the US, we know that Europe does tend to be sort of a standout as on the list for Trump, if you like, for those countries that do have a trade surplus with the US. That's Europe, so that's in the firing line. And that's obviously going to be a concern, because Europe is, economically speaking, in quite a fragile position right now. You know, we've seen latest PMI data are pointing to contraction. Obviously, we've spoken about this political uncertainty and instability in Europe as well, again, which is not a great basis to be sort of, trying to come to any negotiating terms with Trump on. So I think there are a lot of concerns about the outlook, at least in the near term. I think the ECB is expected to continue cutting rates. They might need to do so more aggressively if we do see that slowdown, which could keep pressure on the euro. As far as the UK is concerned, again, I think although we're not necessarily directly in the line of fire in the same way that perhaps Europe is, I think there is a lot of sort of secondary impacts that the UK could be receiving problems with. Obviously, if China gets hit quite hard with with trade tariffs, that's obviously going to be reflecting on in the FTSE poorly, just because of sort of that direct relationship between the FTSE, the miners, and China. So I think broadly speaking, looking out to 2025, we're heading into the year with a lot of caution. I think that it's not the time to be celebrating necessarily, although we're hoping that central banks will be cutting interest rates. That could be more gradually here in the UK. But I think broadly speaking, I said it's very much this wait and see what Trump is actually going to bring to the table.
That is Fiona Cincotta from City Index out of London. Let's come back home, check the local market. We are expecting a lower open there. SPI futures off 0.33%. So stay with us. We will get right across that open in a couple of minutes' time.